Welcome to StockTok's deep dive into analog devices. Analog Devices is a global semiconductor company that designs and manufactures high-performance analog, mixed-signal, and digital signal processing integrated circuits used in industrial, automotive, communications, and consumer applications. At the time of recording, the stock is trading at 399.57. Over the past 52 weeks, the price has ranged from a low of 186.73 to a high of 408.37. The stock is currently trading above both its 50-day moving average of 337.54 and its 200-day moving average of 276.06, suggesting an intermediate uptrend. The Relative Strength Index, or RSI, is reading 76.8, which indicates overbought conditions, a technical signal that warrants attention. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Analog Devices operates as an essential infrastructure provider in the semiconductor ecosystem. The company manufactures highly differentiated analog and mixed-signal integrated circuits that convert real-world physical signals, temperature, pressure, sound, vibration, into digital information for processing and control. This is a foundational capability across industrial automation, automotive electronics, wireless communications, and instrumentation. The company's competitive moat rests on deep analog design expertise, extensive customer relationships built over decades, and high switching costs once customers integrate ADI components into their systems. The StockTok score for analog devices stands at 40 out of 100, which signals caution. Breaking that down across 5 dimensions: valuation scores 0 out of 20, financial health scores 15 out of 20, profitability scores 14 out of 20, growth scores 3 out of 20, and smart money positioning scores 8 out of 20. This is a company with real profitability and financial strength, but one where valuation and growth momentum are raising questions. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Analog Devices trades at a price-to-earnings ratio, or P, of 67.91 times trailing 12-month earnings. That is a material premium to the broad market, which typically trades in the low to mid-20s. The forward PE, or the valuation on next year's expected earnings, stands at 32.65 times, which moderates the picture somewhat but still reflects elevated expectations. The PEG ratio, the PE divided by expected earnings growth, stands at 4.27. A PEG below 1 is often interpreted as attractive valuation relative to growth, and this reading of 4.27 suggests the market is pricing in meaningful expansion ahead. The enterprise value to EBITDA multiple, or EV over EBITDA, which measures the price you pay for operating earnings power, stands at 33.66 times. That is stretched by most historical standards for the semiconductor sector. In our view, Analog Devices benefits from a defensible competitive moat built on decades of analog design expertise and deep customer integration. But that moat does not typically command such premium valuations unless growth is inflecting sharply higher. The GuruFocus Value, a fundamental valuation model based on the company's historical return on invested capital and growth rates, stands at 271.94. The current price of 399.57 sits at a negative margin of safety of negative 36.5%, meaning the stock is trading at a significant premium to intrinsic value, in our estimation based on this model. Wall Street analysts at the time of recording have a consensus mean price target of 393, with a high target of 475 and a low target of 295 across 32 analyst estimates. That narrow consensus around current price suggests limited upside under the median case, though it does provide some downside anchoring. The next earnings report is due May 20th, 2026, with the street expecting earnings per share of approximately 2.90. Market sentiment around analog devices, as of the creation of this video, leans bullish overall, with semiconductor sector strength driven by robust AI demand and broad industry confidence, relative to peers such as Texas Instruments and Maxim Integrated, which have historically commanded PE multiples in the mid-30s to low 40s. ADI is trading at a premium. From a valuation standpoint, we'd characterize the setup as stretched. There is limited margin of safety at current levels, and the market is pricing in a constructive narrative that must hold for the thesis to work. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point accounting quality checklist that examines profitability, leverage, liquidity, and source of earnings, stands at 7.0 out of 9. This is a solid reading. The company demonstrates positive net income, positive operating cash flow, and declining debt relative to assets, all positive signals embedded in that score. The Altman Z score, a bankruptcy risk model developed in 1968, stands at 8.55. A Z-score above 3 is generally considered safe, and above 4 is very safe. At 8.55, Analog Devices sits in the Fortress balance sheet category. There is virtually no financial distress risk here. On the leverage side, the cash-to-debt ratio stands at 0.47, meaning the company has roughly 47 cents in cash for every dollar of debt. The debt-to-equity ratio is 0.26, which is conservative. A ratio below 1 indicates the company carries more equity than debt. Again, a healthy capital structure. The interest coverage ratio, a measure of how many times operating earnings cover interest expense, stands at 10.62 times. That means operating earnings cover interest payments more than 10 times over, providing substantial cushion. The current ratio, current assets divided by current liabilities, a measure of short-term liquidity, stands at 1.76. Generally, a ratio above 1.5 is considered healthy, and ADI comfortably clears that bar. Overall assessment on financial strength. This is a fortress balance sheet. The company has substantial liquidity, low leverage, strong interest coverage, and an accounting quality score in the upper range. This is not a balance sheet risk. If anything, it reflects a mature, profitable business with optionality to deploy capital. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, stands at 6.91%. Return on invested capital measures the after-tax profit the company generates on each dollar of capital deployed. For context, a return on invested capital above 8% is generally considered good, and above 12% is excellent. At 6.91%, ADI is generating returns in line with the broader market cost of capital, but not dramatically exceeding it. There is profitability, but limited excess return generation on incremental capital. The gross margin, the profit remaining after cost of goods sold, stands at 62.84%. This is a very healthy gross margin, reflecting the high-value nature of semiconductor design and the company's ability to price its products. It demonstrates clear pricing power and low direct manufacturing cost as a percentage of revenue. Operating margin, which measures profit after operating expenses like R&D and sales and marketing, stands at 29.70%. This is excellent, nearly 30 cents of operating profit on every dollar of revenue. It speaks to the operating leverage and cost discipline embedded in ADI's business model. Net profit margin, the bottom line profitability after all expenses and taxes, stands at 23.02%. That means the company converts roughly 23 cents of every revenue dollar into net income available to shareholders. That is genuinely strong profitability. Free cash flow margin, which measures the cash the company actually generates and can redeploy or return to shareholders, stands at an exceptional 38.79%. Free cash flow margin often exceeds net margin because non-cash charges like depreciation reduce taxable income but do not reduce actual cash. At nearly 39%, Analog Devices is a cash-generative machine. The return on equity, or ROE, which measures how much profit the company generates on shareholder capital, stands at 7.88%. Return on assets, or ROA, which measures profit on total assets, stands at 5.65%. Both of these are solid but not spectacular given the company's mature positioning. Overall profitability picture. Analog Devices is a highly profitable, cash-generative business with strong margins at every level. The limiting factor is not profit generation. It is the modest return on incremental capital deployed, which suggests the company operates in a mature market where growth is constrained. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at negative 2.8%. That means the company's top line has contracted slightly on a compound basis over that 3-year window. This is a material red flag. A mature semiconductor company should be at minimum holding revenue steady and ideally growing in line with industry expansion. 3-year contraction suggests either market share loss, exposure to declining end markets, or product cycle challenges. Looking at a longer 5-year lens, revenue growth stands at positive 6.2% over that 5-year window. This suggests the contraction is recent, perhaps a cyclical downturn in the semiconductor sector or a temporary demand disruption. But it underscores that the company's growth engine has slowed materially from whatever trajectory existed 5 years prior. Book value growth, which measures the growth in shareholder equity on a per-share basis, stands at negative 1.2% over the trailing 3 years. When shareholders' equity is shrinking on a per-share basis, it typically indicates the company is returning capital to shareholders through buybacks and dividends faster than it is retaining and reinvesting earnings. Book value contraction is not necessarily negative. It can signal capital discipline and shareholder returns. But combined with near zero revenue growth, it paints a picture of a business in mature steady state, not expansion mode. The dividend yield stands at 1.10%. This is a modest payout, reflecting a company that is returning some capital to shareholders but retaining substantial cash for flexibility. The growth picture is clear. Analog Devices is a mature business in a mature market. The company is profitable and generates substantial cash, but it is not expanding meaningfully. This is why the StockTok score assigned a growth dimension score of just 3 out of 20. If you are buying this stock, you are buying for current cash generation and profitability, not for earnings expansion. That is a valid thesis, but it does not justify a PE multiple in the mid to upper 60s range, in our view. Now let's talk smart money. What institutional capital is actually doing with this name? 19 top-tier super investors and gurus, as identified by Dataroma, currently hold Analog Devices in their portfolios. That is a meaningful number of seasoned investors expressing conviction. However, the direction of their activity is mixed. First Pacific Advisors, which holds 6.82% of its portfolio in ADI, has recently reduced the position by 6.03%, a signal of trimming or de-risking. AKO Capital, holding 5.15% of its portfolio in ADI, has been adding, with a recent increase of 2.03%. William Von Muefling at Cantillon Capital Management, holding 3.18% in ADI, has also been adding, with a recent increase of 0.76%. Thomas Gaynor at Markle Group, holding 2.21% in ADI, has reduced the position by 12.37%, a more significant trim. Wallace Whites at Whites Investment Management, holding 2.14% in ADI, has reduced by 4.67%. The pattern here is mixed. Some of the highest conviction holders are trimming, while others are cautiously adding. This suggests skepticism among seasoned value investors even as the stock remains in their portfolios. On the institutional flow side, 11% of 13F institutional filers, that is mutual funds, pension funds, and other registered investment managers, are net buyers, meaning more than half of their recent transactions have been purchases. That is below the 50% threshold, which would indicate broad institutional bullishness. It means institutional money is somewhat balanced between buyers and sellers. Insider ownership stands at 0.34%. That is very low. Management owns almost none of the company. Insider transactions over the last 3 months show 0 buys from insiders and 7 sells. That is a clear negative signal. When management is selling and not buying, it typically reflects skepticism about current valuation levels or concerns about near-term prospects. The smart money picture is cautious. Superinvestor activity is mixed with notable trims from some high-conviction holders. Institutional flow is tepid, and management is quietly exiting positions rather than deploying personal capital. Taken together, we'd characterize smart money positioning as lukewarm at best. And finally, the verdict. Let's bring it all together. On valuation, Analog Devices trades at a significant premium to intrinsic value as we measure it, with a PE multiple in the mid-60s range and a negative margin of safety of nearly negative 37%. That valuation is stretched, in our view, and leaves limited room for disappointment. On financial strength, the balance sheet is fortress quality, with low leverage, strong liquidity, and virtually no default risk. This is a significant strength, and one reason the company has weathered industry cycles. On profitability, the company is genuinely profitable with excellent margins at every level: gross, operating, and free cash flow. It is a cash-generative machine. The limiting factor is that capital is generating low incremental returns, characteristic of mature businesses. On growth, this is the core problem. The company is not growing. 3-year revenue is negative, 5-year revenue is modest, and the business is in steady state. Investors buying at current valuations are betting on a return to growth that may or may not materialize. On smart money, institutional positioning is lukewarm, with superinvestor activity mixed toward trimming, institutional flow tepid, and management actively selling rather than buying. That is not a vote of confidence from the smart money. Bringing this together, Analog Devices is a high-quality, profitable, fortress balance sheet business operating in a mature market with challenged near-term growth. The company is not a financial distress risk, but it is a valuation risk. At current levels, in our view, there is significant risk that expectations have moved ahead of reality. The setup warrants caution. This is a stock best suited for value-oriented investors with a multi-year time horizon who can be patient as the company works through an industry cycle. For anyone considering this at current prices, we would wait for either material revenue acceleration or a more significant multiple contraction. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Analog Devices. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.